People think the market destroys wealth, but the truth is quieter and far more dangerous. It is not the S&P falling 20% that ruins most investors. It is panic rising 80% inside their minds. It is not recessions that wipe out decades of savings. It is impatience, greed, the silent belief that quick money is real money. Buffett once said, "The biggest risk is not price volatility. The biggest risk is how you react to it." Every crash tests your courage. Every bull market tests your discipline, and every emotional impulse carries a price far greater than any market correction. Tonight, we're not talking about charts or forecasts or interest rates. Tonight is about the enemy that follows you everywhere, even when the market is closed, your temperament. If you can master it, you won't just survive the market, you'll outgrow it. Most people believe investing is an intellectual game, a contest of knowledge, a competition of predictions, a race to find the next winner before anyone else notices. But Buffett has repeated one truth for more than 50 years. What really matters is not how smart you are. It's how well you behave when the world stops behaving. Let me tell you a simple picture. Two investors, same age, same income, same portfolio, both bought great companies, both believed in the long term. Yet 10 years later, their lives looked nothing alike. One became financially free. The other walked away with almost nothing. The difference wasn't intelligence, it wasn't strategy, it wasn't stock-picking skills, it was temperament. The first investor didn't check prices every day, didn't panic during corrections, didn't chase hype when others were celebrating. They simply stayed quietly through storms, fear, and boredom. The second investor reacted to headlines, reacted to friends bragging about quick gains, reacted to every red candle as if it were the end of the world, and every green candle as if it were the beginning of a new one. One acted from discipline, the other acted from emotion, and emotion is expensive. Buffett says the market is a device that transfers money from the emotional to the rational, from the impatient to the patient, from the reactive to the calm. But here's the part few people recognize. Your biggest enemy isn't fear or greed. Your biggest enemy is identity. Most investors don't truly know who they are. Are you someone seeking quick excitement? Or are you someone trying to build wealth over decades? If you don't understand your own temperament, the market will define it for you. And the market is never gentle. Think back to the last market drop. Did you feel the urge to escape? Did you refresh your portfolio 10 times a day? Did you measure your worth by a temporary number on a screen? That wasn't the market defeating you. That was your temperament undermining you. Fear doesn't need a crash to activate. Greed doesn't need a bubble to appear. Impatience doesn't need a reason. They only need a small opening before they take over an entire financial life. And here is the uncomfortable truth. You don't need a higher IQ to become wealthy. You need a quieter mind. A disciplined investor with average intelligence will outperform a brilliant investor with poor behavior every single decade. Because markets don't reward emotions. Markets reward temperament. The calm investor, the patient investor, the investor who can stay rational when the world turns loud. Temperament is the real compounding engine, not your portfolio, not your strategy, not the next big opportunity. It is you, your reactions, your patience, your ability to remain steady when others lose balance. The enemy has never been the market. The enemy sits quietly within you, waiting for stress, waiting for noise, waiting for the moment you forget who you promised to become. But once you recognize this enemy, you gain the power to defeat it. And when you do, your wealth stops being fragile and starts becoming inevitable. Fear is the oldest instinct in human history. It kept our ancestors alive in the wild. But in the stock market, that same instinct quietly destroys the very future we are trying to build. Fear doesn't shout. It whispers. It whispers when the market drops 5% overnight. It whispers when the news flashes words like recession, crisis, or collapse. It whispers when you see your portfolio falling faster than you can emotionally process. And fear has one goal: to make you trade your long-term future for short-term relief. Think back to every major crash in history: the dot-com burst, the 2008 financial crisis, the pandemic crash of 2020. Each one of them had the same pattern. People panic-sold great businesses right before they recovered and marched to all-time highs. Fear doesn't care about logic. Fear doesn't care about long-term value. Fear only cares about survival in the next 5 minutes. And here's the irony: the moment of maximum fear has almost always been the moment of maximum opportunity. Yet most investors ran away from the very riches they had been waiting for. Buffett says, "Be fearful when others are greedy, and be greedy when others are fearful." Most people hear the quote. Very few live the quote, because living it requires emotional courage, not intellectual understanding. Let me paint you a common scene. The market drops. Your portfolio turns red. Your heart rate rises. You imagine worst-case scenarios that haven't even happened. You open your brokerage app 12 times in an hour. You say, "Maybe I should just sell before it gets worse." This is fear working perfectly. It wants you to surrender. It wants you to believe you're protecting yourself, when in reality, you're cutting off your own future. Fear makes you sell the bottom. Fear makes you abandon good companies. Fear makes you buy back higher because you feel safer once the danger is past. Fear turns intelligent people into emotional decision makers, and emotional decisions are rarely profitable. But here's the good news: fear is predictable. Fear follows a pattern. Fear has triggers. Fear shows up in the same places, in the same ways, decade after decade. Once you understand how fear behaves, you can step outside of it. You can watch it without surrendering to it. You can say, "Yes, I feel afraid, but this feeling is not the truth, and it is not a reason to destroy my future." Fear cannot ruin your portfolio unless you give it permission. The greatest investors are not fearless. They simply refuse to let fear make the decisions. They let principles make the decisions. They let patience make the decisions. They let long-term thinking make the decisions that fear tries to sabotage. And when you rise above fear, something extraordinary happens. The market stops being a battlefield and starts becoming a partner. Fear loses its power the moment you stop obeying it. Greed is never loud at the beginning. It doesn't arrive with alarms or warnings. It arrives softly, disguised as excitement, wrapped in the feeling that you're missing out on something everyone else has already discovered. Greed convinces you that wealth should come quickly, that opportunity is slipping away, that you must act now, not because the investment makes sense, but because someone else just made money faster than you. Greed turns other people's success into your urgency. Think about every bubble in history. Tulips, dot-com companies with no profits. Housing markets built on illusions. Crypto rockets without fundamentals. AI stocks that people buy without understanding a single line of business. The pattern is always the same. Greed whispers, "This time is different. This one can't fail. This is your chance." And for a moment, it actually feels true. Greed doesn't feel dangerous. It feels like hope. But hope built on hype is just another form of self-deception. Buffett says, "Nothing sedates rationality like large doses of effortless money. When prices rise quickly, your brain begins to believe you're a genius. Your wins feel like skill. Your luck feels like talent. Your speculation feels like strategy." Greed feeds the ego until the ego becomes blind. Let me paint you a familiar moment. A stock doubles in a month. Your friend says he made 6 months of salary in 2 weeks. Social media is flooded with charts pointing straight upward. You feel a fire in your chest, a mix of envy, excitement, and the fear of being left behind. You say to yourself, "I don't want to miss this. I should just buy a little. This is my chance to catch up." This is how greed works, not through hunger, but through comparison. Greed doesn't ask, "Is this a great business?" Greed asks, "Why are they getting rich while I'm standing still?" Greed makes you forget risk, forget time, forget discipline, forget your own goals. It turns your financial plan into a reaction to someone else's success. And then, the quiet twist. The charts stop rising. The hype cools. Reality returns. And people who bought for excitement have no reason to stay when excitement disappears. Greed pulls you into a trade. Fear forces you out. Together, they destroy the very wealth you were trying to build. But here's the truth most people never learn. If money comes quickly, it can leave even faster. Wealth built on hype is fragile. Wealth built on temperament is unshakable. The greatest investors aren't greedy because they already understand the secret. You don't need the fastest money. You need the last money. The money that survives, the money that compounds, the money that stays long after the crowd has moved on. Greed chases the moment. Wisdom chases the decade. And the moment you stop chasing is the moment you finally begin to grow. Impatience is the quiet tax almost every modern investor pays, not in dollars, but in lost opportunities, abandoned positions, and dreams that were sold long before they had time to grow. We live in a world where everything is instant. Instant messages, instant delivery, instant entertainment, instant feedback. So people begin to believe wealth should also be instant. But the market does not reward speed. The market rewards duration, the years you stay, the storms you endure, the boredom you tolerate while nothing seems to be happening. Impatience is dangerous because it feels so reasonable. It tells you, "I've been holding this stock for months. Why isn't it growing? I deserve results by now. There must be something better out there." Impatience pretends to be logic, but it is simply discomfort wearing a suit. Buffett says, "The stock market is a device for transferring money from the impatient to the patient." He didn't say it with anger. He said it with acceptance, because decade after decade, he watched people sabotage their own compounding simply because it didn't happen fast enough. Think about a tree. For years, it looks like nothing is happening, just a thin trunk and a few weak branches. But beneath the soil, The roots are wiring themselves into the earth, becoming strong enough to survive storms long before the first fruit ever appears. Investing is the same. What matters most is invisible for a long time. The growth is underground. But impatience makes you dig up the roots to check if the tree is working. Every investor has lived this moment. You hold a perfectly good company. The fundamentals are solid. The business is growing. The long-term outlook is clear. But the price moves sideways for 6 months. Or maybe it dips a little, and impatience whispers, "This is a waste of time. Move on." So you sell. You chase a different stock. You chase a hotter sector. You chase a louder story. And months later, the original stock you abandoned starts climbing, slowly at first, then powerfully, without you. Compounding doesn't punish you for being wrong. It punishes you for rushing. Impatience makes people jump in and out, buy high, sell low, and repeat the cycle until years of effort produce nothing but exhaustion. Here's the irony: most investors don't lose to the market. They lose to the passage of time because they can't sit still long enough to let time work for them. A great business needs years, not weeks. A great investment needs discipline, not constant stimulation. Real wealth grows slowly, then all at once. But only for those who remain long enough to see it. Impatience is the most expensive habit because it steals the only ingredient that makes compounding unstoppable: time. And time only serves the investor who knows how to wait. Overconfidence is the most deceptive of all emotional traps. Fear feels heavy. Greed feels exciting. Impatience feels restless. But overconfidence feels smart. It convinces you that you understand more than you actually do. It tells you that your recent wins were not luck, but talent. It slowly turns a beginner's luck into a veteran's arrogance. Overconfidence doesn't show up on day one. It arrives after a few good decisions, after a couple of profitable trades, after a streak of being right. And suddenly, you start believing the rules no longer apply to you. Buffett says, people with high IQs often get into trouble because they think they're too smart to need discipline. Overconfidence whispers the same lie. You're different. You won't make the mistakes others make. But the market humbles everyone eventually. Let me paint a familiar moment. You buy a stock. It goes up. You feel proud. You think you saw something others didn't. You feel your confidence rising. So you take a bigger risk. It works again. Now you feel unstoppable. You start giving advice. You start predicting the future. You start believing you've unlocked some secret formula, and then the market shifts. Something unexpected happens. Momentum breaks. Volatility returns. And the strategy that made you feel brilliant suddenly stops working. This is where overconfidence becomes dangerous, because overconfidence doesn't just affect your decisions. It affects your perception. You stop seeing risk. You stop seeing warning signs. You stop questioning yourself. You begin to treat speculation as if it were certainty. And certainty in the stock market is the beginning of destruction. Overconfidence leads people to hold positions too long, to ignore fundamentals, to double down on losing trades, to take leverage they cannot handle, to assume they can outsmart the collective wisdom of millions of participants. The truth is simple. When you think you can't be wrong, you're already moments away from being wrong. Overconfidence destroys portfolios quietly, not with one bad decision, but with a pattern of misplaced certainty that grows stronger each time luck disguises itself as skill. The greatest investors in history all share one surprising trait: humility, not insecurity. Humility. The awareness that markets are unpredictable, the acceptance that no one is always right, the discipline to admit when reality changes, the wisdom to say, "I don't know," and still take intelligent action, because overconfidence wants you to believe you are in control. But true mastery begins when you finally accept you are not. And that surrender is not weakness. It is strength. It is the foundation of durability. It is what keeps wealth alive through storms, cycles, manias, and crashes. Overconfidence asks, "How can I beat the market?" Wisdom asks, "How can I stop beating myself?" And once you learn to silence that hidden arrogance, your decisions become cleaner, your risk becomes measured, your growth becomes sustainable, and your wealth begins to compound without self-inflicted wounds. Overconfidence builds the illusion of control. Humility builds the reality of survival. In the end, the market is not your opponent. It is simply a mirror. It reflects your patience. It reveals your discipline, and it magnifies every emotion you tried to hide. Fear, greed, impatience, overconfidence. These aren't market forces, they are inner forces. And if you can master them, you gain something far more valuable than a high return. You gain control over yourself. Buffett once said that a calm temperament is the rarest advantage in finance. Not intelligence, not timing, not forecasts, just the ability to remain steady when the world grows noisy. Your wealth doesn't begin in the market. It begins in your mind. And if you can train that inner voice to stay patient, to stay rational, to stay humble, compounding will take care of the rest. If this message brought clarity or calm to your journey, consider subscribing. Here, we build wisdom, not hype. And we grow wealth the way it was always meant to grow. Quietly, slowly, and unshakably,